This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So let's go through and have a look at the adjustments for the group statement of profit or loss. And there aren't a huge amount of adjustments to think about. We've already actually thought about two when we looked at the basic consolidation, by thinking about your mid-year acquisition when we prorated the subsidiary's profits, and also removing the dividend income that we receive from the subsidiary to prevent double counting, because we've consolidated S's profits and we don't want to put in any more of those profits again by keeping in the dividend income received from the sub. Okay, so we've already dealt with two adjustments. Were you happy with those? Yeah, I think you should have been. Okay, if you work through that example again, practice some examples from whatever study text you're using, then you should be quite happy with the fundamentals. The adjustments themselves don't go too crazy because they follow on from the same principles as what we've seen before from the statement of financial position, and that was all about the single entity, wasn't it? So we only want to look at what happens between the single entity, the group, and the outside world. Anything that happens between P and S, or S and P, we ignore, or if you like, we eliminate, don't we? The first one that we've got there is intragroup trading transactions. Could be due to sales, could be to loans or debenture interest. Okay, so maybe the parent has lent money to the subsidiary, in which case the subsidiary has interest expense and the parent has interest income. And then it could be management charges. So maybe the subsidiary uses some of the head office of the parent, and again the parent will charge the subsidiary for it. So the sub has an expense and the parent has the income. Key bit is whatever it is, there is an intra-company amount, isn't there? Okay, nothing has gone on between the group and the outside world. It's just purely between P and S, isn't it? So if that's the case, we need to first of all remove the expense. We then need to remove the income, and that, because it is not profit affecting, is done in that adjustment column. Okay, so if it's done in the adjustment column, it's not profit affecting. It will therefore not impact the non-controlling interest. Okay, but it will impact revenues, costs, finance cost, interest income on a line by line basis. So if we think about it with regard to your sales, because that is the most common one, we remove the expense. So you credit your cost of sales, which reduces cost of sales, and you debit the revenue, which reduces revenue. Debits and credits, forget them. Reduce revenue, reduce cost of sales. Okay, there we go. That should be nice and straightforward. If you have made some intragroup sales, then it could be that some of those intragroup sales are still left in inventory at the end of the year, in which case there will be a PUP adjustment, isn't there? Okay, so you need to work out the PUP, again, using your markups and margins. So as it says there, is it your cost structures? And to do that, you increase the cost of sales in the seller's column. So it's important, if the subsidiary is the seller, that you adjust the sub, because that will then have an impact on the non-controlling interest. Okay, because when you total up S's column, that PUP adjustment is in S's column, and therefore it will impact S's profits for the year, which then impact the NCI. Okay, why do we increase cost of sales? Well, if you think about it from a group SFP's perspective, the adjustment that we had there is that we debited the retained earnings, didn't we? And we credited inventory. Okay, that was the journal entry that we posted, wasn't it? The key issue that you've got now is that we're being specific about that debit to retained earnings. If you're debiting retained earnings, remember that is reducing profit. To reduce your profit, you are going to have to increase your expense. And the specific expense that it is with your cost of sales, isn't it? Okay, because it's an expense that forms part of the cost of selling those goods to, is it the parent or is it the subsidiary, depending upon the direction of travel. Okay, there we go. So two little bits to add on to what we've previously seen. Again, we're going to work a full example to give you a full understanding, and then you can start to practice the objective test questions, because I think without a full understanding of how it works, you can't even begin to answer the objective test questions whatsoever. Okay, so what we've got is there is an example underneath, isn't it? It's there called unrealized profits. We can just about, I think, squeeze it in. We need to move it up and down a bit. We need to move it back down again, don't we? Because we need to prepare the Gary group. So again, Gary is there as the parent. The statement of profit or loss as expected for December X5. Okay. So again, we're going to go through and consolidate. Gary owns 80%, so has control. So there is a 20% NCI. And Nick is there, the subsidiary, isn't it? Okay, the company controlled by the parent. That was bought on the 1st of January X5, so that's the start of the year. So if you like, there's no mid-year acquisition. If you wanted to be really picky, you could write 12/12. Okay. Goodwill on acquisition has been impaired during the year and should be charged to your operating expenses. So we have an impairment in the goodwill. So we will need to adjust for that impairment within our financial statements. And then it says during the year, Nick sold 10 million of goods to Gary. So Nick is the sub. So if there's any pup, we will adjust Nick's column. And there were 10 million of goods sold. So that is the intra-company sales. Again, when we're working out the pup, it's a 25% markup. And there are a quarter of those goods left in inventory at the year end. So we will adjust for the intra-company sales in full, but the profit effect we only need to adjust for a quarter of it. Okay, so that's something that's quite tricky, and we will deal with a little bit later on. Okay, so what have we got? Let's go through. Get yourself a blank piece of paper. We need there, is it the group statement of profit or loss? We have the parent, we have the sub, we now have your adjustments column, and we then have it there for the group, don't we? If we go through there and think about it with your revenue, you've got, is it 120,000 of the parent, the subsidiary is there as 90,000. Okay. Don't worry about the adjustments just yet. Cost of sales is that there as 70,000, and is it 40,000? Okay. Now we worry about the adjustments. The adjustments that we've got, there was an intra-company sale, wasn't there? There was an intra-company sale of 10 million. It doesn't matter who sold the goods. We need to adjust for the 10 million by reducing revenue and reducing cost of sales. Okay, so what you've got there, that adjustment is for your intra-company sales. Okay, excellent. There we go. We then need to adjust for the PUP. Okay, your provision for unrealized profit. And the key bit here is that PUP adjusts cost of sales, and you also adjust, don't you, in S's column. And I think here S was the seller. Was S Nick? I think Nick was the sub, wasn't it? Yeah. Nick sold the goods, 10 million of them, markup of 25%, and there are a quarter of them left. So in terms of my calculations, we're working in thousands, so 10,000 multiplied by 25 125ths multiplied by a quarter. Does that give me 500? So the PUP adjustment that you have is there as 500. Everybody happy with that there? Okay, yeah. We're adjusting for a quarter because there's a quarter left, and we only adjust for the goods held in inventory at the end of the year. And then your standard percentage, 25 125ths on the markup, isn't it? Okay. If you wanted, exam questions might just ask you to work out the revenue. 120 plus 90 less 10. The group revenue is 200,000. The group cost of sales is always that little bit more of a challenge. Okay. 70,000 and 40,000. You've got the 500 as well before you then reduce it by the intra-company sales. So I think there, if we put it in the blue, that's 100, 500, which gives me a gross profit of 99, 500, isn't it? Okay. Everybody happy with that bit there? Okay. Excellent. Your operating expenses, 100% of P, is that there as 20,000. The sub is there, is it as 35,000. The impairment, we're going to add it in. It depends upon what you've got in the question. If memory serves me right, I'll need to double check within the syllabus, but I don't think impairments are actually covered. So I could potentially remove this. You know, an impairment is just a reduction in the value of the goodwill. And if it's not on the syllabus, close your ears. Okay, I will double check and let you know. But the impairment, you just record it. Okay, 20 and 35 is 55, plus 1 is 56, isn't it? Now, what's going to happen there is it was a million, wasn't it? Yes, 1,000. So what will happen is it will either go in the parents column or it will go in the subsidiaries column. It will go in one or the other. Okay. Why will it go in one or the other? Well, it depends upon how goodwill is measured. And goodwill here, we're not told how it is measured deliberately so that we can talk about it. You know, so if you've got, if you like, NCI and the full goodwill method, so valuing NCI at the fair value of the NCI, then you put the impairment in S's column so that the non-controlling interest get their share of any impairment. If you're using, is it your partial goodwill, so you're using your proportionate share of net assets, then you will put it in the parents column, because the subsidiary, if you like, the non-controlling interest, will not suffer any impairment because the goodwill we've calculated is the parent goodwill only. Okay, so we don't want to give any of that impairment to the NCI. Okay, I think we see more of that in F2 if memory serves me right. Okay, keep it, whichever column you put it in, it goes in one or the other. 20 plus 35 is 55, plus 1 is 56. Okay, what we will do is, just to go through there and keep it simple, is we will go through there and assume there that we're using the partial goodwill. It's an assumption, the partial goodwill, and put it in the parents column. Okay, in the exam, if it were to appear, which I don't think it will, you would have to go through there and be told. Okay. Other bits that you've then got is that there as the finance cost. So is that there 2,000 and is that there 500? So that gives me 2,500. Again, I'm not worried about PBT. Tax you've got, is it 6,000 and is it 3,000, which gives me 9,000. Essentially, that there's nothing else to do within the question that we haven't seen before. Okay, we've done the adjustment at the top, which is all that was required. So I total things up for the group, isn't it? So 99,500 less 56,000 less 2,500 less 9,000. Double check for me. I think your group profits are 32. 99,500 less 56 less 2,500 less 32,000. Okay, we then need to go through there, don't we, and split that amount into what is attributable to the parent, so what the parent owns, and what the non-controlling interest own. And the non-controlling interest own, is it 20% of S's profits for the year. Okay. So you need to total up S's profits for the year column, and that's why it's important that you've got these figures in the right columns, isn't it? So 90,000 revenue less 40,000 cost of sales less the 500 for the pup. Okay, if you put it in the wrong column, you're going to get the question wrong. The operating expenses will deduct 35,000. We're not going to deduct the impairment because we'll assume it's the partial goodwill. Deduct the 500, deduct the 3,000. Does that give me, is it 11,000? Okay. I take that 11,000. Oh, careful, gone too far. 20% of 11,000. I think it's 2,200, isn't it? So 11,000 is it as S's profits for the year. We control all of them, so that's why they're included in full in the group profit, but we don't own all of them, do they? The NCI own their share. So what's then attributable to the parent? Here's the difference between the 32,000 and what the NCI own. Oh, sorry, not 11,000. Careful, Christopher. It was 2,200, wasn't it? So there, 32,000 less 2,200 is that there as 29,800. And as always, that is a balancing figure, isn't it? Okay. I think what you can begin to see there and start to develop an understanding of is we now can see the full picture, which is great. We're still going to use the same calculations and the same workings when it comes to answering questions, but exam questions are going to ask you to work out the revenue. So it's 100% of P, 100% of S. Don't forget to prorate S before you then adjust for any intracompany sales. Imagine if you were asked to work out the cost of sales. Wow, that's 100% of P, 100% of S that's prorated. You need to adjust for the PUP and you need to adjust for the intra-company sales. That's the one whereby you will make the most mistakes in terms of the adjustments. After that, I really don't think you'll be asked for much else with regards to operating expenses, finance costs and tax. The only other bits that I think you would be asked with regards to as questions would be to go through there and ask you to work out the NCI. And I've thought that would be quite hard, picking out the particular bits from the question. And then if they were really evil, they could ask you to work out the figure from the parents. Okay, but I think if they were to ask you to do that, they'd have to give you enough information so that you don't make any mistakes and there therefore be any continuity errors. Okay, that would be very unfair to penalise you if you understand the concept but have made an error earlier in the question. Okay. So there we go. Have a work through that example. Have a work through the previous example. Make sure you're happy with them. Hammer through the questions. Some of them are quite tricky. Some of them are ridiculously straightforward. But other than that, that's it. There's a tiny little bit within the notes, I think, there. That if we just go through and talk about it, we'll talk about it within the next lecture. Okay, it's just extra, if you like, non-computational aspects about whereby control can exist if we don't own greater than 50%. Okay, but we'll leave that until the next one, shall we? Other than that, I'll see you all for a short, sharp session when we talk about control in the next one.